So FSDH on a monthly basis publishes its report tagged Insight and Opportunities, where economic activities in preceding months is analyzed, as well as outlook on a fresh month. September, in this case, is also given. Now, the latest is that of September, as I said, and the reports came with global and internal events, and of course, analysis as to how it will shape investor sentiments in the financial and capital markets at large. Mr. Ayodele Akinwumi, who is the head of research at the FSDH group, is here again this evening to help us understand what has been published this time. Good evening. Thank you for joining us on Capital Market again.
Thank you for having me.
This is Capital Market off the Nigerian Stock Exchange floor, actually. So let's look at your report, Insight and Opportunity. What would you say you found in August, and what is new or what is different in September?
Okay, thank you very much for having me. I think in August, our report looks at development in the global economy, domestic economy, and also the different markets that we operate, and how those developments in the global market, domestic market, shape activities in the financial market. And then we look at opportunities for investors to take in the market. So in the global market, we realize that growth is still very sound. The US is growing at about 4.2, very solid. Inflation rate is rising, now higher than the target set by the US Federal Reserve. Then the unemployment rate also very low, and those are indications that the FOMC may likely, that's Federal Open Market Committee of US Federal Reserve, may likely increase rates when they meet between 25 and 26 of this month, and that has an implication for the global economy in terms of the financial market, and particularly for the emerging market. There may likely be increased yield in the US and other advanced economies, which may likely make funds to move from emerging market to the US. And then the response from that for emerging market, including Nigeria, will then be how do they increase rates, because that could be a pressure on the currencies. Now, in terms of this, so that's major development there that the policymakers are looking at and how they are going to react to that. Then in terms of the global market last month, and of course the National Bureau of Statistics published the Q2 number, which we thought was quite fragile, very weak, growth 1.5. And more importantly is the fact that the dominant sectors of the Nigerian economy seems to be under threat. Agriculture, remember the last time when they published Q1, I was on this program to discuss that number. The Q2 number that was published, agriculture for the first time in a very long quarters recorded very fragile growth, 1.19%, which is very not good enough. The second largest sector of the economy, which is trade, contracted. In fact, actually not only contracted, it entered recession, meaning that 2 consecutive quarters of decline, contraction. We also noticed that the oil sector, which is about 9% of the GDP, but then the implication, the impact of that sector on the economy is not less than 50%, because it supplies foreign exchange for the country, it supplies revenue for the country, so it has a multiplier effect on all that, on manufacturing, being able to allow the companies to have access to foreign exchange to buy input. So it's quite high on the economy, but we've seen contraction in that place, which may further place a lot of pressure on the foreign exchange. And then even the other sectors, which is manufacturing, growing very marginally, the real estate for us is in depression, a protracted, contraction. So this also have a lot of implications for financial market. And of course, you saw when the central bank wants to raise the second auction for Treasury bill in the month of August, the rate went up significantly. The 1-year paper Treasury bill from about 12, 13% to about 15% within 2 weeks. That's very massive. And of course, it may likely be in reaction to the weak growth in the economy, which also may not even encourage credit creation. People are talking about banks lending to economy, to real sector. But when the economy is not growing very well, the banks will be a bit hesitant to lend money to them, and therefore may also lead to job losses, may not allow job market to expand.
Which in fact explains the reason why we now have this level of unemployment rate and of course the weak spending or purchasing power that we now have in the system. But basically, how will you say all of this will impact, especially for the retail side of investments now in the how will this impact retail side of investments for retail investors who are supposed to take position now that offshore investors are seemingly, taking flight from our markets?
Okay, good enough. We now analyze the numbers that the Nigerian Stock Exchange published actually for the month of July. We noticed that the retail investors in the stock exchange are actually growing, which is very important, which is very good for the country because it provides some little stability for the market. And of course, they are not as reactionary as the other institutional investors in the market and even the foreign investors in the market. But we need all of them because the foreign investors and the institutional investors drive activities in the market. But then it's literally about risk aversion. People, when an economy is contracting or is leading to a recession, because the growth we saw in that quarter, if nothing urgent is done, we may likely slip back into recession. And therefore, people are looking at taking cover and then wanting to go and look for where do I preserve my capital? And that's where we are. Those are the activities that we are seeing on the Nigerian Stock Exchange now. It also makes funding costs increase because when you say that the economy, the risk inherent in the economy is rising because of the fragile growth, people, the loanable fund will be reduced and the available funds will command higher interest rate. And the central bank also wants to say, what do we need to do not to put the exchange rate under pressure? Can we raise interest rates? Can we yield on fixed income securities to enable both the local investors not to take their money out of the country or to attract foreign investors? So that's what we're beginning to see in the market.
Okay, so what are the measures that the government, and of course we generally, because it's not all about the government alone in this case, what are the measures that we now need to take? I know that, yes, across the country, when you go upland, it's difficult for people to survive. Civil servants hardly get their salaries paid. In fact, this is also beginning to impact on the private sector upland.
Okay, so we issued a report in FSDH research last week, which was published on Monday this week. And we looked at it, looking at the GDP numbers. And each of the sectors, we break them down and provide some measures, policy actions that the central bank, the federal government needs to do. In terms of the agri sector, we link the low growth, the sluggish growth there, 1.1, to the security problems in the country.
It's not about the fact that we are yet to see the harvest season.
No, is it the figure, when you talk about the harvest season, the figures that central bank and the NBS publishes is quarter on quarter. So it's not like the growth between first quarter this year and then second quarter this year. No, it's this same quarter this year versus the same quarter last year. So that issue of seasonality effect is being removed from there. So we are saying this time last year, in Q2 last year, between then and now, the GDP grew by 1.5. Now, the agriculture, which is the largest sector of the economy, grew marginally by 1.19. Now, what we are saying is government needs to engage the relevant people in those states where we have issues, and government needs to admit there is a crisis. Because sometimes if we read in newspapers what you journalists are publishing, which we are reading, they are saying that even sometimes they may not even agree that it's actually a real problem. So we need to admit that there's a real problem for us to engage them and find lasting solutions to this.